The fight between active and passive investing has been going on for a very, very long time and is likely to go on for a longer time more, especially in India. Now, what is active investing? What is passive investing? And what should you be going after? Let's understand this a little bit detail. But first up, a story. At Kailasa, Lord Shiva and Parvati were sitting and having a conversation. And Narada arrives there and hands Lord Shiva a celestial mango. And he says, this mango will give immortality and great powers to the consumer. So that's when both the children of Shiva and Parvati, Ganesha and Kartikeya arrive. So obviously the fruit cannot be cut. So the Lord has to offer it to one of his sons. Instead of making an arbitrary choice, Lord Shiva says, I'm going to have a small competition between the two of you. The one who can circle the world 3 times and quickly come back first will get the mango. Hearing this, Kartikeya grabs onto his peacock. It's a very swift vehicle. He runs. He starts going around the world, Earth, once, twice, thrice. He's on that journey and looks like he has an unassailable lead. His brother, Lord Ganesha, is a little bit stout and has a mouse which is no match to the peacock. So there is no way Ganesha is going to kind of catch up to Kartikeya or even overtake him in the wildest of dreams. But Ganesha has a very different thought. He says, my father said I have to come around my world, and my world is my father and mother. So he does things very differently. He goes around both his father and mother 3 times and then goes to his father and says, I have gone around my world 3 times. Please, I am eligible for the fruit, give me. Now we know what happened. The fruit was given to Ganesha and his father happily smiled. And of course, his brother was very upset. Lord Kartikeya was very upset with this and so on and so forth. But the point is that everybody's perspective on a subject is different. And nobody is right and nobody is wrong. Now, the same arguments holds truth for active and passive investing. So let's look at what is active investing. Active investing is when a fund manager manages a certain fund. He does an analysis of the industries that he wants to invest in. He looks at all the different industries, finds out the most promising industry that he wants to invest in. Within that, then he drills down into the specific companies that look interesting, their governance, their performance, their profitability, their track record, and various other factors before he zeroes in on the individual stocks. And then he constructs his portfolio. It's a very painstaking, it's a very data-driven exercise, something that is very, very difficult for everybody to do. But he does that. He has a large team of analysts who help him do that. So he creates a portfolio very consciously. Now, this comprises of a variety of different stocks, different industries, so on and so forth, but all of them in which he has very high conviction. Active fund management is about building your conviction. The fund manager is convinced that every single stock that he holds in his portfolio are going to be multi-baggers in the years to come. That is, they're going to give multiple returns, and that's why he is staying invested in them. That's what active portfolio management is all about. So there is a fund manager, there is a conviction, there's a lot of research, a lot of homework. On the other hand, passive investing or index fund investing is a reasonably easier process. Now, what is an index? In India, there are 2 main indexes that we follow. One is called the Sensex, which is nothing but the Bombay Stock Exchange top 30 companies which are pulled into a certain index. Similarly, you have National Stock Exchange Nifty, that is National Stock Exchange 50 companies, top 50 companies that are pulled into an index. Index is like a bellwether. Index will give you a sense of how the market is performing at any given point in time. Is it up, down, so on and so forth. Index by itself has no meaning, but looking at two values on two different dates, you know whether the market is on an upswing or a downswing, as the case may be. So it gives you a perspective. It's like a temperature chart, so to say. Now, index investing or passive investing, as it's called otherwise, is nothing but buying exactly and replicating the index. So for instance, in the Sensex Bombay Stock Exchange 30 index, if Reliance is say 12%, then as an index fund, you are expected to hold 12% in Reliance. That's all. You don't use any further intelligence. You keep mimicking the index at all points in time. Is it 12%? We'll keep 12%. If HDFC Bank is at 8%, you will also hold 8% of HDFC Bank in your index fund portfolio. So it's really about just kind of mimicking the portfolio. Doesn't involve great intelligence. You can have a simple Excel software that can play the role of a fund manager, telling you what you need to buy and what you need to sell. So index funds are reasonably low in maintenance and low cost to manage. Now, globally, there are people who believe index, because it crowdsources the intelligence of everybody, is really the true bellwether of the market. So by being an index, you naturally will benefit out of how the market behaves. So the global number of pundits who believe index fund investing or passive investing is the way to go create long-term wealth. In India, as we have seen in the past, that at various points in times, active fund managers have beaten the index. Of course, in recent past, we've also seen at various points in times, index funds give better returns than active funds. Whether it is active funds or passive investing or index investing, as it's called, friends, the trick is to be disciplined and be in the market for a long term. As long as you are staying true to the character of your investment, stay disciplined and look at it from a long term, both these options will create wealth for you. One, of course, the active fund manager is always trying to give you that little extra return, but passive investing has its own role as well. So pick your choice, or better still, take a little bit of both. You can't go wrong.